Welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. Today on the show, we're going to talk about how 10 types of accounts are taxed. Now, likely this list of 10 that I'm going to go through here, many of you watching or listening will either have these assets, these accounts, or will have these assets or accounts by retirement. And the 10 I'm going to go through are traditional IRAs and 401ks, Roth IRAs and Roth 401ks. We're going to talk about pensions, Social Security, life insurance, annuities, the sale of things like stocks, bonds, and mutual funds, how dividends are taxed, how interest-bearing accounts are taxed, and then we're going to end on how your home will be taxed. This is going to be part one of a part two video series, so make sure that you subscribe to the Make Your Money Matter show so you never miss a single episode. All right, let's get started with part one of how different types of accounts are taxed. Leading the way, we're going to start with number one, which is traditional IRAs and 401ks and how they are taxed. Look, savers, investors out there, we all love tax-deferred retirement accounts like 401ks, like traditional IRAs, because why? Because contributions to the plans generally reduce our taxable income, which basically saves us money on our tax bill in that current year that we contribute. And their savings, their dividends, the investment gains in these accounts continue to grow on a tax-deferred basis. That's the benefits. What some tend to forget is that they will have to pay taxes down the line when they retire and when they start taking withdrawals, and that those taxes apply to their gains and their pre-tax or deductible contributions, which we're going to talk about here today. Now, for many out there, you can delay withdrawals, but the money can't stay in these accounts forever. At some point, you must withdraw the money from the accounts, and we know this as required minimum distributions, otherwise known as RMDs, and they currently kick in at age 73 for certain holders of traditional IRAs and 401ks. Now, people who work, by the way, past age 73, they can actually delay their RMDs from their current employer's 401k until they retire. Again, provided they don't own more than 5% of the company that now employs them. So if you turned 72 in 2022, you would have likely had to take in your first RMD by April 1st of this year. Now, withdrawals from traditional IRAs and 401ks are taxable. And here's the key point here on number one, taxable at ordinary income tax rates. Though any after-tax or non-deductible contributions, they are excluded. Now, payouts before age 59 and a half are generally slapped with another 10% penalty on top of the regular tax hit. Like all of these that I'm going to go through today, these are really important to make sure you speak with your CPA or your tax advisor about your specific situation. Moving into the second account I want to talk about is Roth IRAs and Roth 401ks and how they are taxed. Roth IRAs come with a big long-term tax advantage because contributions to Roths aren't deductible now in the current year, but the withdrawals later are tax-free. The two most important caveats here that I want everyone to know, you must have held the Roth IRA account for at least 5 years before you can take a tax-free withdrawal. And second, although you can withdraw the amount you contributed at any time tax-free, you generally must be at least age 59 and a half to be able to withdraw the gains without facing an early withdrawal penalty, again, of 10%. Now, similar rules apply to the Roth 401k. Roth 401k contributions are not deductible, and withdrawals in the future are tax-free, again, provided at least 5 years have passed since you've contributed to the Roth 401k. By the way, the 5-year period on the 401k begins on January 1st of the year that you first contributed to the Roth 401k and then ends 5 years thereafter. So those are little caveats there on that. Third up is pensions. For those of you out there who have a pension, whether it's from a private company or maybe a government pension, pension payments that you receive from private and governmental pensions are fully taxable at ordinary income tax rates when you receive them, assuming you've made no after-tax contributions to the pension plan. And this is a great income-oriented tax discussion to have, again, with your CPA, along with all of these. Again, you should relate all these to your current and specific tax situation. Fourth up, and this is the one I get talked about a lot and many questions on, is Social Security and how Social Security benefits are taxed. Friends, some Social Security benefits or recipients aren't subject to federal income tax on their benefits, but others, depending on their what's called provisional income, aren't so lucky and may have to pay federal income tax on up to 85% of the benefits. Now, before I go into anything further on this is a great suggestion here to speak with your CPA and tax preparer on, helping you determine what your provisional income is as it relates to your Social Security taxes that may or may not be taxed. Fifth and final for part one here is how life insurance proceeds are taxed. Now, any proceeds you receive as a beneficiary of a life insurance policy when the insured person passes on, they're generally non-taxable. Now, the tax rules are a little more complicated for the holder of the policy, and if you surrendered it for cash. The separate item, by the way, the IRS has an online tool for many of you can look at to help you determine whether the proceeds you receive are taxable. But for the most part, if you're the beneficiary of a life insurance policy, they are generally non-taxable. As I've shared many times before, I'll touch on this in part two. Life insurance and real estate are two of the best asset classes to pass on to your heirs, something to speak with your advisor about. So that is part one of how certain types of accounts or assets that you own, whether now or in retirement, are taxed. Make sure to stay tuned for part two. We're going to go through items like annuities, the sale of stocks, bonds, and mutual funds. We're going to talk about how dividends are taxed, how interest-bearing accounts are taxed, and then ultimately, we're going to talk about how your home, the home sale essentially, is taxed. So make sure to subscribe to our show and always remember to make your money matter.